Guys, we're very excited about this next keynote that's coming up. We've got Uwais Asmal, who's the head of advisory at Outsource CFO, who's going to lead us in a keynote that he's especially prepared for this session here today. We're really excited to hear him speak. It's about the profit first methodology that's really been taking the entrepreneur world by storm over the last while, where I think the concept of entrepreneurial poverty, where founders build companies for 8 or 10 or 12 or 15 years, but they never start that process of actually figuring out how to take proper money out of the business. And as a result, the founding team remains kind of like financially constrained over a long period of time because all money gets plowed back into the company, saying that it's kind of fueling growth. But at the end of the day, it's not always necessarily that. It's maybe just a lazy excuse for not figuring out how to properly set aside profit. So Uwais is going to take us through a rock solid methodology that Mike Michalowicz out in America coined for the first time, and we're very keen to hear what he has to say for us. Uwais, over to you, sir.
Thanks so much, Lau. Welcome, everybody. If you don't mind, I'm going to share my screen because I prepared a little bit of a presentation. Okay. Can you all see my screen? Lau, if you don't mind, just letting me know if you can see the screen.
Yeah, perfect.
Okay, perfect. So my presentation, welcome everybody. My presentation is about Profit First by Mike Michalowicz. And it's difficult to summarize a book into 20 minutes, but into 10 minutes, sorry, but I'm sure I'll give it my best. So before we jump into the book, let's talk about the Mark Cuban stimulus plan. So most of you will know him, but if you don't, who is Mark Cuban? So Mark Cuban is an American billionaire, entrepreneur, and investor, and his net worth is estimated at $4.3 billion. He's also one of the shark investors on Shark Tank, for those who don't know. So what is his stimulus plan? And let's talk a little bit about that. So his stimulus plan, it consists of 20 rules that will get him to invest in your company. And I'm only going to focus on 3, but practically only 1. And his one rule is the business must be profitable within 90 days. Another one is a business must cash flow break even within 60 days. And you can't break even on a cash flow basis without being profitable. So if you want Mark Cuban to invest in your business, you need a profitable business. So I'm going to mix it up a little bit. Instead of talking about the book, I'm going to talk about the biggest mistakes when applying the book. But you might be saying, Uwais, you're talking about the mistakes, but you haven't explained the concept yet. So I'll explain it a little bit, and then I'll talk about the mistakes. So a quick profit first lesson. The main thing about profit first is setting up 5 separate buckets: an income bucket, a profit bucket, a tax fund, owner salaries, and operating expenditure, in that order. And those buckets must be separated into separate bank accounts. So you might ask me, what are you talking about, Uwais? How does the money flow? And I have a bit of a diagram to show you that. So all the income that comes from all of your clients goes into one account, the income account. And you don't pay OPEX from your income account. You allocate from your income account a little bit into profit, a little bit into tax, a little into owner salary, and a little bit into, or the remainder into OPEX or operating expenses. Practically, that's all you do. You never pay anything else from your income account. Your income account is there to receive money and to split it into the different categories. The reason being is you're going to only use your operating expenses account to pay your expenses. You're not going to pay operating expenses from any other account. You're going to have a smaller pool of funds to work with. The whole point of Profit First is about setting up a structure to help, because as business owners, you all have this habit of, I plan my expenses based on the money that I have in my account. So if you're only planning it on what's in your operating expenses account, you might think differently and become more efficient with your money. So let's talk about these mistakes that are made when people try to apply the Profit First methodology. And the first mistake is going it alone. The Profit First is not, it's a simple method, but you are your biggest enemy in applying it. When you start taking money from your tax account or your profit account to start paying for operating expenses, you shouldn't be doing that. But sometimes you're tempted. If you've got an accountability partner to watch you, you will make sure you will reap the benefits of Profit First. Too much too soon. So what do I mean by that? So Profit First requires you to set different target allocation percentages for each section, so for each bucket. So every time you get, or when you make payments into your different buckets after you receive cash from your clients, a percentage goes to profit and a percentage goes to tax. But if you set too high of a percentage going to profit or to tax, you won't have enough money to pay your salaries. You won't have enough money to pay your OPEX. So you cannot apply your target allocation percentages straight up. You need to work from where you currently are and work gradually over, and it's not over a few days, it might not even be over a few months, gradually to move from your current position to your target position. So you cannot go from 0 profit to 20% profit in 1 quarter. That's not possible. You're going, because you're always going to end up, I need money for something else. I need to go back to my profit account and take money to pay OPEX. So you need to apply slowly. After you set your goal, you calculate what's your current allocation percentage. And every quarter you move from your current allocation to your target. And he specifically points out that you only move by 1% at a time. So if you didn't have any profit before, in the next quarter, you're going to have 1% profit or 2% profit. We're not going to jump 10% in a quarter, because if you could do that, everybody could do that. It's important to start slowly, because moving slowly will force you to look for better ways to be more efficient. And it won't tempt you to throw in the towel, because it's not necessarily the easiest way if you've been making losses to all of a sudden make profits. But if you're doing it slowly, 1% at a time, it becomes easier to achieve. And that's what you need to do. Mistake 3 is, I like the idea of profit first, but I want to grow my company. So too many entrepreneurs think you can only have one. You can either have profit or you can have growth. And what the book and what this book and profit first methodology points out is spend and growth go hand in hand. Growth without profit is actually making you poorer, because you're making losses. Who's spending that money? You're making yourself poorer. Then you might tell me, but always Google and Facebook have done it. Now I'll tell you, yes, the Springboks have also won the World Cup. So does that mean that I can also win the World Cup? These are exceptions. That's why they are on the tour list. That's why they are famous. Some companies have been going from funding round to funding round for the last 10 years without making a profit. And then you ask yourself the question, if you've been making losses for the last 10 years, who's winning? You're not winning, you're making losses. Maybe the suppliers are winning, but it's not you if you've been making losses for the last 10 years. Some of you want to grow at all costs. At all costs means you are one of those costs, if you think about it. If your profit comes first, your business will automatically show you that path to growth. So commit to profitability from day 1. Mistake number 4 is cutting the wrong costs. Not all costs should be cut. You need to invest in assets and costs. Assets and costs that bring more efficiency to your business. Costs that allow you to get more results at a lower cost per result should not be cut. If a cost makes it easier to get better results, you should keep those costs or purchase those costs by buying the asset, as an example. You'd rather consider different costs or discounted options or services, but don't sacrifice efficiency in the name of cost savings. Don't cut the wrong costs. The next mistake, plowing back or reinvesting. Entrepreneurs like to use these fancy words. I'm reinvesting in my business. I'm plowing back the profits to cover my expenses. And all you're doing is you're taking money away from your profits to pay expenses. In a profit first methodology, that means you're taking money out of your profit account and putting it in your OPEX account. And that's a big no. This only happens if you are allocating too high a profit or too high a owner salary in a profit first methodology. So don't plow back or reinvest. Set the right targets and move towards the right targets, and you will start making profits. If you do not have enough money in your OPEX account, this bank account that you've set up to cover expenses, that's a big red flag. That means your expenses are too high and you need to fix them. I know that sounds easier said than done, and you don't think you can reduce your expenses. But let's take a look back to April and May 2020, when with the impact of COVID, you managed to adjust your expectations. You managed to adjust your budget during difficult times when revenue was decreasing, when you were taking hits on your revenue. So if your revenue is staying the same, you can also reduce your expenses within reason, of course. and you proved it to yourself before. Mistake number 6 is raiding that tax account. So you have a tax account that you've been putting money into, and now all of a sudden you just want to take money from your tax account to pay OPEX. That's a big mistake. Number one, you won't have money to pay SARS. If you don't have money to pay SARS, penalties and interest for underpayment, and I mean, that's 20%, those are big numbers. And if you do manage to pay SARS, that means you took money from somewhere else. So you took money from your OPEX to pay SARS. Now you don't have money in your operating expenses account to pay your operating expenditure. So do not take money out of your tax account to pay for anything but tax. You only take money out of your tax account after you paid SARS, and the remainder goes to profits. It's never for paying expenses. And something to keep in mind, and entrepreneurs don't necessarily like this, but as your profits grow, your taxes will grow. It's a side effect of a growing business. Yes, you don't want to pay too much, but you have to pay as your profits keep growing, your taxes are going to keep growing. So please keep that in mind. Any healthy business, the tax keeps growing as the profit grows. Mistake number 7 is adding too much complexity. The profit first methodology is simple. Set up these 5 bank accounts: an income account, a profit account, a tax account, owner salaries, and operating expenses. And in the online banking system that we've got today, you can actually rename those accounts in the online banking so you know which account is which, and you're not trying to figure out which account is which. It's not complex, it is simple. It's easier than losing weight, and losing weight is simple. Eat well and exercise. That doesn't mean it's easy, but it's simple. And this is easier than losing weight if we think about it from that point of view. Mistake number 8, skipping the bank account. What I mean by that is some people say, okay, I'm not going to open the bank accounts. I'm going to apply profit first methodology, but I'm going to create balance sheet accounts on my trial balance and not open the bank accounts. This is a no, because you know that you make decisions on whether you can pay expenses or not, on how much money is in your bank account. If you've only got one bank account, you're watching that bank balance in that one bank account. Some of you check it every day. So, but you're not checking your balance sheet every day. So it's best if you must set up each bank account, and instead of watching your full bank account, you're now watching your OPEX bank account every day, because that's the bank account that you're going to be paying out all your different expenses. So don't skip opening the different bank accounts. That's key to the profit first methodology. So coming back to how we mentioned at the beginning, setting up those 5 bank accounts: income bank account, profit, tax, owner salary, and operating expenses. Now you'll notice that I did not say how much you need to allocate to each one. The book gives examples, but each business is different, and you need to find the right allocation for your business. You're going to start from where you are, and you're going to move slowly from where you are to where you want to be. And it might be that on your journey to where you want to be, you might realize that my initial thought of where I wanted to be is maybe too high for my business. So initially I thought that a profit percentage of 20 was for me. You might end up at 10 and saying, okay, this is actually good for a sustainable business, and my business can run perfectly at this level. But have a look at the book, and it will also give you a guide. Now you might ask me, Uwais, what if I'm making losses? My question to you is your business sustainable? If you are making losses, then start with a 1% profit, just a 1% profit. Small steps. Remember, coming back to my Mark Cuban stimulus plan, your business must be profitable within 90 days. 1% profit is profitable. So start small, start at 1% profit if you've been making losses. And if you haven't been making losses, then you just push it up by 1%. And it's managed, the profit first methodology, you manage it on a quarterly basis. So every quarter you push it up. Going back to my Mark Cuban stimulus plan, it must be profitable within 90 days. Thank you very much. If you do want more information, please have a look at the book. I hope I was in my time low.
Brilliant, Uwais. Yeah, that was perfect. Thank you so much. That was a really good summary. I love what you did with it in terms of the mistakes founders make when trying to apply this. Guys, if you're new to profit first methodology, like Uwais said, like spend the time, listen to that book or read it, have a look at the website. There are some really cool templates and tools, and maybe then chat to Uwais about how one can apply this within your company. We're super excited about helping founders create profitable companies while they scale fast. That's really exciting. Thanks, Uwais. Appreciate it, champ.
Thanks so much.